We've had a leadership crisis in this country in business for quite so many years now, and we're starting to see the impact of it sort of showing up right now. Business is an infinite game. There is no finish line. There's no such thing as winning business. But if we listen to the language of too many leaders, they talk about being number one, being the best, and beating their competition. The problem is there's no agreed upon objectives and there's no agreed upon timeframes. And when we lead with a finite mindset in an infinite game, there's a few very consistent and predictable outcomes: decline of trust, decline of cooperation, and decline of innovation. And we're starting to see all those things play out right now.
But hasn't all of those things always been the case with business, having very competitive CEOs? I mean, what's different now?
Having competitive CEOs is not the issue. It's what's driving the CEOs. A lot of the standard business practices that we consider normal today have not always been the case. For example, shareholder supremacy, where we define the purpose of business is to maximize profit within the bounds of the law, really was only popularized during the 1980s and 1990s. The use of mass layoffs on an annualized basis to balance the books did not exist in the United States prior to the 1980s. And we used to reward and pay senior executives and professional executives based on the performance of the company, not necessarily the performance of the equity. So we're starting to see this sort of focus on the more finite and the more short term that really ramped up and popularized in the 80s and 90s and now is considered normal, and we're seeing some of the problems.
Though I wouldn't say mass layoffs to balance the books is normal today, though there might be some examples of it. Though what you're pointing to anyway is something that came up with the Business Roundtable recently, where they did make an announcement to try and encourage a shift towards more management for stakeholders, not just shareholders. And in fact, earlier today, Jamie Dimon was discussing that. He, of course, was chair of the Business Roundtable at the time they made that announcement. Let's take a listen.
And I do think that we try, and I'm speaking for a lot of companies, try to do a tremendous amount to help the communities, because there have been people left behind. But, the inner city schools are not failing because of banks, okay? And infrastructure is not failing because of banks. So I think we can help build infrastructure, help train people, get work skills, get involved in education systems, like all the kind of stuff that a lot of us all do in Detroit. We can lift up society, and I think it's good for us to lift up society. And, when society does better, everyone does better.
Should all CEOs be thinking as broad as society? I mean, JP Morgan's the biggest bank in the land. It's a slightly different kettle of fish. But yes, I can understand a shift from not just shareholders to stakeholders as well, whether that's customers and employees. But should all people be thinking, all managers be thinking as broad as society?
Ultimately, when we prioritize the wants, needs, desires of our employees and our customers, it does benefit society as a ripple. I mean, people who work in places where they like going to work are happier people. Happier people treat their kids better, treat their spouses better. Yes, there is a ripple effect to society. But being purpose-driven, and this is the thing that sort of irked me about the Business Roundtable statement, being purpose-driven doesn't mean giving to charity. It's not your corporate responsibility program. That's not what we're talking about. What we're talking about is taking care of your internal people before you take care of the external people. And I was a little cynical when that statement came out. I mean, don't get me wrong, I think it's good that companies are talking about being purpose-driven, but the people they used who signed the letter in the press release, the spokespeople, sort of, you had Johnson & Johnson that just paid a massive fine for their involvement in the opioid crisis, and even Jamie Dimon's company just a few years ago announced record layoffs the exact same year they had record bonuses, which is an interesting correlation. I would have preferred to have seen some of the CEOs or former CEOs like Jim Senegal or Kip Tindall from Container Store and from Costco, thank you, be better representatives, because they have been stakeholder driven for decades. It's not a recent thing. So, I want to know, are they truly changing the way they're doing business, or are they just responding to public pressure?
And quickly, final question on WeWork. What's your take on that, and whether the sort of failings of that company were really worth some blame for Adam Neumann, or whether he was trying to plan for the long term and that hit issues in the short term?
Well, I enjoy watching them all blame each other, and at the end of the day, they're all to blame. I mean, the board should have been watching more closely at somebody who had sort of seemed to have lost control and sort of was enjoying the trappings of success a little too much. And at the end of the day, Neumann probably also obviously deserves some responsibility there. I think everybody deserves to raise their hand and say, I think we screwed up a little bit.